Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, we're talking with Rodrigo Gordillo, President of Resolve Asset Management and Trading Advisor to the Return Stacked ETFs. Rodrigo, thanks so much for joining us.
Thanks for having me.
Absolutely. So, Rodrigo, you have a suite of returned stacked ETFs. Can you tell us what stacking even is?
Yeah, I mean, stacking came from over 15 years of banging my head against the wall, trying to get advisors to make room in their portfolios to add derivatives and investment alternatives. So the firm that I run, Resolve Asset Management, has been running alternative strategies that are non-correlated to traditional equities and bonds. And I'd always spent my time asking advisors to explicitly add alternatives. What I didn't understand was that by asking them explicitly to add their alternatives, what it meant was that they needed to implicitly take away their favorite toys, which is the equities and bonds, and investors' favorite toys, equities and bonds. And so it was the hurdle rate for alternatives was to every year try and do better than equities and bonds, which is a tough thing to do when trying to create non-correlated strategies to add on top. So the idea of return stacking came by understanding just a couple of changes in the regulatory environment, the 18F rules, that made it very clear what we could do with derivatives inside ETF wrappers that allowed us to answer the diversification problem with a yes and solution. So rather than telling advisors to take out equities and take out bonds, we could create pre-packaged solutions that gave them one-to-one exposure to their favorite beta plus an alternative. And so this now allows investors and advisors to really stack those alternatives on top while maintaining their core stock and bond exposure. So, the ETFs that we launch are $1 in the S&P 500 and another dollar in managed futures trend, or $1 in aggregate US bonds and another dollar in managed futures trend. Another one that we've launched recently is $1 in US in global equities and another dollar in US bonds, right? And that could be used in many different ways. But it was just a way to just give advisors what they need, along with what they've always said they want but can't hold on to long term.
That's great. So it sounds like you're essentially buying $2 worth of assets for $1. How are you obtaining that leverage that you're using?
Yeah, we use it through futures contracts, which is kind of the most efficient way to capture those exposures in the cheapest borrow, because you're in essence, going to be borrowing in order to get that extra exposure, right? And the cheapest rates you can get in the derivative space is through futures and exchange traded futures contracts. So if we're going to do, like I mentioned earlier, the S&P 500, we'll mostly use ETFs that track the S&P 500 index for a big chunk of that portfolio. But there's going to be a portion that is left in cash collateral that we can then use a S&P 500 futures contract to top up what we needed to top up to get 100% exposure, and then use the rest of the cash collateral to run those managed future strategies on top.
Gotcha. And Rodrigo, have the benefits of leveraging changed given that interest rates have gone from, 0 up to 5%? Does that kind of decrease the appeal of leveraging?
So that's a common misconception. This idea that, well, now that rates are high, then taking risk in things that are not cash is a bad idea. But if that were the case, then the capital markets, as we know, wouldn't really work, would they? Right? So if cash yields are going to be higher than bonds forever, or cash yields are going to be better than equities forever, then we would just move slowly towards cash to the point where it'll be more accretive to put money to work in the equity markets, right? So what you're really looking at in terms of stacking things on top is the excess return that one could get by allocating dollars to these strategies. So when you think about a managed futures trend strategy or any other type of alternative contract, what you want to do is you want to find out what their excess returns are, and you do get excess returns for taking that risk long term. And then it's the excess returns that you're really stacking on top. And so whether cash yields are 0 or it's 6% or 10% historically, over a full cycle, you see, well-designed alternatives and equity markets and bonds that are higher in duration. They tend to be higher than cash, even though what we're seeing in bonds today momentarily is an inverted yield curve. That doesn't stay there for long, as I'm sure we'll see soon.
That makes sense. And you touched on some of the ETFs that you have in your suite, Rodrigo. Are there any in particular that you want to highlight as being, really high demand right now in the current environment?
Yeah, the one that we launched second is the one that has the highest assets under management, and that is the RSST, that return stack stocks in trend. That one gives you, for every dollar that you invest in that ETF, you get a full dollar of an exposure to the S&P 500 and another full dollar of managed futures trend. And the reason that I think this is popular is because it tends to have very, very low correlation to equities when you stack managed futures trend on top. Trend following strategies have empirically and historically shown to provide really good offsets during periods of acute pain in equity markets, right? By the virtue of trend following trends. If there is a kind of market and prolonged trend downward in equities, you will see a managed future strategy be able to go short equities, short commodities, go long treasuries. Like if it was a non-inflationary bear market like in 08, you saw managed futures trend make most of their money in treasuries. In 2022, when equities and bonds both went down, you saw it make most of its money by shorting bonds and going long energies because it was a high inflationary period, right? So it just tends to have this nice little offset in the worst of the tail events in equities. And it also tends to do fairly well during inflationary regimes, which tends to also hurt equity markets. So I think it's a perfect complement to an equity portfolio, and why we've seen a lot of pickup in that product. I don't expect that to stop anytime soon, especially in this environment.
And what types of investors do you see, allocating these ETFs into their portfolio? Who are they designed for?
Honestly, we are seeing it from the full spectrum. They are designed for everybody because I think what's happened in the last few years is a recognition that the traditional 60/40 portfolio alone isn't going to get you into safety in all types of market environments, right? We've tended to believe that 40 years of disinflationary growth was going to be here forever. And in 2022, we recognized that stagflation environment could be something that's going to stick around for a while. We see sticky inflation today. And so as investors and advisors are looking at the new economic regime, the new macro environment, recognizing that they need to protect against bear markets and inflation regimes tends to be at the top of the agenda of trying to figure out how to do this. And again, you could do that by subtracting the things that you love the most, or you can do it by stacking these alternatives that are pretty good in those environments on top. So I feel like we're getting a lot of demand from, of course, the advisor space as they're looking for solutions to this very difficult problem.
Fantastic. Well, Rodrigo, a ton of great information. Thanks so much for your time.
Thank you, Sumit. I appreciate your time.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.